Good morning. My name is Kevin Kim, partner here at Fortra Law. I lead the firm's corporate and securities division. I am also the host of Lender Lounge with Kevin Kim. Today we have some of my favorite CPAs in the industry with our friends at Armanino. So guys, welcome to the webinar. I think everyone on the call probably knows you guys, but let's just do some intros real quick and give us some information about Armanino, and we'll get started. Who wants to go first?
Hey, hey guys. Ryan Barragar here, tax partner at Armanino. Been working with our private lenders over the course of the past 5 or 6 years, especially when it comes to implementing REITs into their structures to take advantage of some of the tax efficiencies that we're going to be talking about over the next hour or so. So excited to be here, Kevin. Thanks for having us, and I kick it over to David.
Yeah. Hi, everyone. David Erard. I'm the leader of our real estate tax practice here at Armanino. I work with Ryan and Jason and Kevin and a number of folks on a lot of these REIT implementations. I know there's some other topics that we might want to cover as far as interesting things in the big, beautiful bill, which I still have trouble getting that phrase out of my mouth, but excited to be here. Hopefully we can answer some tax questions and give everybody a little bit of guidance. Certainly not intending to try to make anybody an expert throughout this, but more to maybe give you some prompts and some ideas and an understanding of how the big beautiful bill might be impactful to you and your clients.
All right. So as you guys know who are listening in, the point of today's webinar is to go over the One Big Beautiful Bill Act, and it was enacted on July 4th, signed by the president. It passed by a hair in both houses, and we are currently now making sure that we understand the implications of this, both for private lenders, but also in general, right? So, but this is not the big chunk of this bill that's really meaningful for us industry people is actually not new, right? A lot of this stuff isn't new. So anyone want to set the stage for us? It's kind of I guess you can call it the historical aspect of the tax implications for this bill and how it all got started and where we are today with it.
You want to take this one, David?
Sure. So I think the way I think about the big beautiful bill is a lot of it has to do with extending things that were added on a temporary basis during the first Trump administration. One of the big items that came into the code that's affected a lot of our private lenders was this section 199A deduction. And it just, without going into the weeds on exactly what that is, it works out that to be a reduction in your tax rate effectively via a deduction of 20% of the income that it relates to. And for private lenders, some of the requirements for that 199A deduction look to the amount of W-2 wages and the amount of basis and depreciable property. So absent adding a REIT to the structures, the lenders were not able to qualify for this benefit under the way it was set up. So one of the benefits of the 2017 bill that has now been extended is that 20% deduction applies to REIT dividends without regard to the depreciable asset basis standard or the W-2 wage standard. So it became the REITs became a fairly clear path to being able to get the deduction that you otherwise would not have been able to. So we saw a huge uptick, and along with Kevin and his team, of folks in this space really looking hard at whether adding a REIT to their structure or converting their structure into a REIT would work out to be in favor of your investors. So I don't know the numbers off the top of my head, but I'm going to guess we've worked on 40 to 50 of these REIT implementations together. And I think we found that for folks that are lending against real estate, the REITs can be a very good option. The process that we go through is, we'll have one-on-one conversations with folks that are considering this, just to help you understand exactly what a REIT is, how does that change things, what should your investors expect. So it's a little bit of an education process on what, state of play today versus what the REIT and the structure. But we found that most of the clients that we've spoken with, after we run through the pros and the cons, have chosen to add these REITs into these private lending structures. So from a headliner perspective, Kevin, I think that's the big change from before that remains relevant to our lending clients. The big beautiful bill did extend or make permanent the 199A deduction. Just for a little bit of background, the corporate income tax rate was also reduced from 35 to 21% as part of that 2017 bill. I think of the 199A deduction as a parallel reduction to the individual tax rates, but only for certain types of income. So that's probably the headliner. There's other things that are being discussed, but again, I think of the big beautiful bill largely as being an extension of things that were already there. If you think it'd be helpful or interesting, we can talk about maybe some of the more heavily negotiated provisions and what people were thinking about, Kevin, but I'll defer to you on where we go from here.
Yeah, let's set the stage a little bit, because I think the bulk of our conversation will be around the REIT strategy, because that is a meaningful deduction for investors in the sector. But there are other aspects to this bill that are remarkably influential to both our audience as lenders, but also their audience, right? So their borrowers and such, right? How will this influence the real estate investor community as well? Because ultimately, if they win, we win, right? So, that's I would like to kind of just give a high level touch of, like, the different features that this bill has that are outside of the 199A extension or made permanent part. For example, there's things about you know, I can call it the depreciation rules. There's this discussion on SALT. There's a lot of things that were really important to people who are lending and also people who are investing. All right. So any other meaningful discussion points to bring up? Let's talk about them.
Yeah, maybe let me cover the state and local deduction or SALT, and then Ryan, I'll ask you to cover the depreciation part of it. The state and local tax deduction. So just to give everybody some context and background, prior to 2017, state taxes were deductible by individuals. There were some limitations for like alternative minimum tax and some other things where maybe you didn't get full benefit, but the general rule was that state taxes were fully deductible. So that basket included things like property tax as well as state income taxes. And not to make this a political conversation, but blue states tend to have higher state income tax rates than red states do. And so I think as part of the 2017 bill, they added in a $10,000 annual cap on people being able to deduct their state income taxes on personal returns. And that had the most impact on places like California and New York, where state income tax rates are fairly high, and also property tax rates were fairly high. So even your middle income earners were running up against this $10,000 SALT cap. And that was probably one of when they passed the bill in 2017, that was certainly one of the pay fors. Meaning when they go through and they do these bills, they have to look at the budgetary impact of the tax breaks that they're giving, and then the ways that they're generating revenue through new streams of tax. So reducing the benefit of state income taxes was what I think of as one of the big pay fors of the 2017 bill. It also, not surprisingly, has not been all that popular with people, because there are a lot of even middle income earners, like I was saying, that run up against these limitations. So a big part of the horse trading and a lot of the headlines prior to the passage of the big beautiful bill had to do with, should we expand the SALT cap? Should it increase from 10,000 to a larger number? And that did happen. It went up to 40,000. but it also phased back down to $10,000 fairly quickly for people in the higher income brackets. I think it starts to phase back down after 500,000 of income. So long story short, the SALT cap is still in place. It was increased to 40,000, but I would expect that most people who would really benefit from it are still going to be capped at that $10,000 amount. Because of the political sensitivity on it, and really which states were suffering, or where citizens were likely to run up against the cap. It was one of the, I would say, kind of the headline conversations, at least as a tax guy, on one of the very interesting points that they were negotiating. But like I said, they did keep the SALT cap. They did keep a SALT cap in place. It was increased. That increase phases out. And then on a secondary issue, for those of you that have a lot of income that you're receiving on K1s from partnerships, there was a lot of conversation around whether they would change the rules to prevent some workarounds that were put into the code, where a partnership would pay state income tax on behalf of a partner, and the partner would be able to deduct that without being subject to the $10,000 annual cap. So a lot of noise around the SALT cap, and I think it got a lot of attention because it is a sensitive item and who it was impacting. But there's not really, I would say, as I'm looking at it now, I don't think things on the SALT rules are a whole lot different for people in 2025 than they were in 2018.
Very good. Ryan, you want to touch on the, and we're going to go a little deeper later, but we want to touch on the other aspects that you know about?
Yeah, I would say the other big component of the bill that a lot of our real estate clients were keeping a keen eye on was the bonus depreciation. So bonus depreciation, as many know, the benefit was being reduced by 20% every year until there was going to be a complete phase out in 2027. This new bill stated that bonus depreciation is restated, and not only is it restated, it's at 100%. So all your short-lived property is eligible to be basically expensed in the first year for any asset that's been placed in service after January 19th, 2025. So that's a big win for our real estate owners, and something that's going to generate a lot of deductions up front that's going to help with their tax strategy.
All
Yeah,
right.
and Kevin, that's a huge financial impact for people that own real estate. And it's certainly kind of one of the themes of the big beautiful bill is the intention of incentivizing people to build things and do things within the US, which is part of the reason the bonus depreciation came back. I don't know that it's going to be directly impactful to the those that are lending, but I think it from a business standpoint, probably helpful to understand the issues and the benefits that some of your borrowers might stand to get from through these bonus depreciation,
Correct.
and additional expensing provisions.
And many of our listeners are also, ancillarily involved in real estate investing as well. So it's important to know all of it. It's a meaningful thing for all of them. And also those of you listening who want to buy a heavy ass car, there's that's appreciation there.
So,
JC,
Ryan, you touched on something that I want to make sure that we call out, because the bill is effective January 19th. So if there's a 19-day funky window at the beginning of the year that if you place something in service as of January 1st, it doesn't become effective till the 19th, right?
I think it's a little bit more nuanced than that, Jason. I think it applies to tax years ending after January 19. And it's kind of fascinating as to why they would pick that date. But for the gist of it would be, for most people, that means these provisions kick in 2025 because your year ends on December 31st, 2025. But there's got to be some fiscal year thing, or sometimes when they're proposing a bill, they'll pick a cutoff date based on when something was initially proposed. So I don't know off the top of my head which, the reason why they picked January 19. It could be something as petty as there's a fiscal year company out there that has a January 20, year end, or January 18 year end. It could also be something that they built into or put into the bill based on when things started being proposed.
But also just because they're lazy and publishing the Federal Register is it's hard to do.
It,
So
it could be. It could also have to do with January 20 being the day that the administration's changed. So they're,
right, right.
pick a reason. But yeah,
Yeah.
Jason, your point is well noted that for most people, these provisions are effective in 2025. If you happen to have a weird, a fiscal year that ends sometime in the first 18 days of January, and in 26 years of practicing, I've seen that 0 times, but it's possible somebody does.
All right. So let's get deeper into this 20% deduction because this is the big mover and shaker for all of us. We've been watching this like a hawk. I know I have. Everyone was for the past year and a half now, people on the fund side have been reticent to go in the direction of the REIT strategy because they were of the mind that it might get killed at the end of this year. Now that we know that it's made permanent, let's get into the deduction itself, and then let's kind of get into the REIT aspect of things. So give us the details of the deduction because it's nuanced. You guys gave some color earlier. It's not necessarily eligible for everybody, any kind of business. Certain kinds of businesses qualify, certain kinds don't, correct?
Correct. So at high level, most businesses would qualify for this if you're just manufacturing and distributing, doing just running kind of a prototypical business. And then they carved out a few businesses for like consultants, accountants, lawyers,
Yep.
fund managers. So people that were on whatever, however we got onto the naughty list, I guess we got there. So there's some businesses that were carved out from it. And then they have standards that you have to meet in order to get the deduction. And so maybe I'll back up and just talk about the mechanics of it. So it's not something your fund or if you have a REIT that the REIT would claim as a deduction on your own tax return. It's something that is passed through in a sense. So you give, in like a fund setting, you would have a K-1 going to investors that would have information that they would use to calculate the deduction on their individual tax returns. So one of the, in my view, well-negotiated provisions from the last time around was that REIT dividends. And so there are 2 types of REIT dividends. There's ordinary dividends, which I think of as a distribution of like rental income or interest income. There's capital gain dividends, which get taxed at capital gain rates. So from a REIT dividend standpoint, the 20% deduction applies to those ordinary dividends. And the vast majority of what our clients in the lending space would be passing out to investors will be ordinary REIT dividends. So those qualify without regard to a couple of thresholds that were put in relating to how many, that part of the incentive was we want you to buy property in the US and we want you to hire US people. So you'll get this 20% deduction as long as you have what the rules would think of as an appropriate amount of wages in the business or an appropriate amount of depreciable property used in the business. So again, kind of the incentive back in 17 was we want you to hire people and we want you to buy stuff. Fortunately for those that have REITs, there is a real synergy from a private lending standpoint in the sense that the REIT dividend and adding a REIT to the structure is really the most likely and probably only way that the type of income that you're getting from private lending is going to qualify for this deduction. So, Kevin, I don't know if it'd be helpful to go any more in the weeds than that, because we could probably spend a couple hours talking about it, but
Right.
that's kind of the gist of it.
Yeah, and I think it's important for the folks to know, like, the truth behind the deduction is technically for your funds, your investors who are below a certain threshold of income or depreciable assets could technically, if you're just a regular fund, you're not a REIT, you don't have a subsidiary REIT or you're not a REIT, your investors can technically qualify on their own if they individually, as the investor, can meet the necessary threshold requirements, right? If they're capped out, they're capped out because of their income or their net worth. But if they're not, they're eligible to claim it for regular funds. So for our audience members who do not have their REIT yet for their fund, but want to understand the eligibility for their investors, it is available to them provided they are under the certain bracket. Now, my understanding is the bracket phase out is a little bit higher now.
Yeah, I think they changed that a little bit, but the gist is you weren't subject to the wage or depreciable property limitation if, you know, a given person's income was less than 350,000 a year, and I think that might have been increased to 400 under
Yeah.
the big beautiful bill. So yeah, some investors, Kevin, would qualify for that deduction without a REIT. But I don't know offhand how many folks are getting investment of a meaningful size from folks that are, would be below those thresholds.
Right. And from a strategy standpoint, this is probably the reason why this became such a popular trend was the vast majority are running accredited investor only, targeting family office, high net worth, ultra high net worth type investor. They're going to be well above the bracket, right? So they're going to
Yeah.
be phasing out. So that's an important consideration as to why to think about this as a meaningful deduction for your investors. And it is on them, right? It's not necessarily us that we should be educating our investors as to you should be taking your K1 to your own tax people and claiming this deduction. And to be clear for our audience, I get this question all the time. This only applies to taxable investors. If the investor's vesting is a non-taxable plan, it does not apply to them. If you got an offshore feeder fund, that complicates a lot of things as well. So we're not gonna get in the weeds of that. We could spend hours on that one as well. Okay, so let's talk about. We know now that going into a REIT will ensure that anybody who's taxable can get that deduction, which is the big reason why I know Jason and I were doing a lot of road shows together with clients from 17 all the way to kind of 19, 20-ish, right? So, um, and explaining this to clients from a strategy standpoint. Now, because this has become so prevalent, you guys, we've done so many together, and collectively, the industry has done so many, and so this has become kind of standardized amongst fund managers. It's become quite common to see as an add-on component early stage. And I think our groups both advocate for the REIT strategy to be a subsidiary REIT strategy as a means to maximize efficiency. Ryan, Jason, you guys want to kind of talk about that? I know, Jason, you and I have presented that to clients many times, but I know, Ryan, you're running on that side now. So anything you guys want to talk about as it pertains to the structural component as to why clients are going in that direction?
Yeah, so I think it can be a little bit scary when you say add a REIT to your structure. So just from a high level, what you're doing is you're creating a new entity that sits below the fund, and the fund is 100% owner of the REIT. So you're adding a new entity, and that entity is a special type of entity for taxation purposes. It falls under the corporate rules, but where it gets specialized tax treatment is the REIT receives a deduction for all the income that it distributes throughout the year. So that's how you're going to reduce the double layer of tax that a corporate entity generally generates. So it's a hybrid. It's corporation, but it acts like a flow through because there's minimal entity level tax. There are some actual ancillary benefits for the REIT to be taxed as a corporation. So not only does it receive the 20% deduction, but it also, by virtue of being a corporation, it blocks UBTI, unrelated business taxable income, that your tax exempt investors are very sensitive to. And it also blocks the state source income at the fund level. So working with a lot of fund managers, a lot of the questions that we receive are, how do I block UBTI? I have a lot of IRA investors. They just can't have it. How do we get rid of that? And UBTI is generated by either participating in ordinary business activities or investing in a partnership that has some kind of leverage to it. So you're taking on debt to create income. So when we have all the activity being held at the REIT, it will block all the debt, anything like that. You're just the investors receiving a REIT dividend, which would not be subject to UBTI and not subject to tax. So that's a really important issue. Second is when you don't have a REIT and you have a fund and you're operating in different states and lending in different states, you kind of have to source the income to where the activities are held. And different states have different rules that create kind of a tax issue where you're providing K1s to these various states to all your investors, and they may be filing in 15, 20, 25 states, complicating their own individual tax return. And there's withholding rules that each state can apply from time to time. So you create this big administrative burden by operating in other states. And when everything is pushed down to the REIT kind of captures all of that, and the investor will pay tax. They'll pay federal tax on their REIT dividend, and they'll pay tax in their home state on the REIT dividend because it'll block all the other state source income
That's
from flowing to the investor.
hugely, like from an operator standpoint, it's a huge burden off of everybody. I mean, I have so many clients that a lot of their investors move to, like, California lenders who their investors move to Nevada, Texas, Florida, and they're so upset now because they have to pay for California income tax. This is one of the most, like, interesting components. It reduces the operational burden on the client significantly, it seems like. To comment on the UBTI aspect, I've significantly seen, like, I have a client that said, even if this tax bill died, this year, I kind of don't care. The UBTI aspect alone has opened so many doors for us because there are certain types of investors when you're going out and raising capital, they can't touch anything that has UBTI. So, like, a lot of these, like, charities and endowments, and they can't touch UBTI. And so this is massively beneficial for our clients who have access to those types of investors. They can now raise the money, right? There's a lot of interest in those communities because they need an income type investment. So it's a really interesting opportunity for those of you guys who are really now storming those beaches and getting out there, and you kind of hit the cap on the accredited investor kind of community. There's a lot of interest both in the RIA community and in the non-taxable quasi-institutional investor community that really love the fact that there's no UBTI in this. Jason, you and I spent a lot of time together on the road with clients advocating for the substructure, right? And there are a lot of reasons why. I can get into the tactics of it, but I really want you to kind of share your thoughts on it because you and I sat in many rooms together with clients and walked them through it, many phone calls, and I think it's really valuable for our listeners to understand, like, why are we doing this as a sub-REIT? I get this all the time. Oh, I can do it in my fund right now. I've got 100 plus investors. I got this, I got that. Like, give us your perspective on it because I like the way you explained it last time we were in a room together. So.
Well, let's be honest, back in 17 and 18, we weren't sure how long this was going to last.
Oh, for sure, right?
We were all hedging on the fact that it was going to be good while it was here, and then if it disappeared, how do you get out of it?
Correct.
Because as Ryan and David will attest, once you make the REIT election, so if you do the REIT election at the fund level, you're not going back. You're baked. It's set. You can't unwind it. Like you'd have to close the fund and start launch a new one to get out from underneath the REIT election. So by doing the sub-REIT, it gave us all the flexibility of, okay, if this thing actually sunsets some point in the future, we just close it up, right? Wind down the REIT. It's a sub of the fund. Move all the loans back up into the fund. The REIT goes away, and you just go back to being your standard fund structure. What we found along the way, while we were hedging for the tax bill changes, was the sub-REIT gives a large amount of flexibility in the way that you handle the assets, the way you deal with, performing and non-performing. You start having foreclosure proceedings and deed low, you take back the assets. It's not easy functioning with those assets in a REIT. Mm-hmm. There's nuances, and Ryan and David could jump into like the heavy details of those nuances, but it's nuanced as soon as you start taking back the property and where you house it in the REIT, and if you keep it in the REIT. So by having the sub-REIT, you had the flexibility to park those assets back up in the fund.
Or a TRS, right? In a taxable REIT sub, right?
Or you can go to a taxable REIT subsidiary, but it didn't force you to automatically create a taxable REIT subsidiary. You didn't have to. You could just park them back up in the fund. You can move them out of the REIT, and you had some flexibility to move assets or make some moves. If you had bad REIT income, or you had an opportunity to generate income that was going to be bad REIT income, you still had the fund sitting there as a standalone entity. You could just make those investments up at the fund. If you made the REIT election as your main entity, you lost a lot of flexibility.
Mhm. And from a tactics standpoint, whenever we're designing a fund strategy, most of these are open-ended. Flexibility seems to be the priority for a lot of sponsors because you're going to be operating this thing for, I mean, the longest one we've seen in operation is 20 years. It's, you're going to be running this thing for a long time. And you need flexibility in the business plan and in operations. So, and that's to me the shining beacon of why a sub-REIT makes the most sense. I've also found that tactically speaking, I really like the ability. For me, it's almost like an insurance policy, right? Because God forbid you were to screw up on the compliance, right? And we're not going to get into the compliance today. I've done a bunch of webinars on that. We'll link to those in the below because we have a bunch of webinars we've done on that. But God forbid you were to mess up on the compliance, you can kind of go back, you can live to fight another day with your open-ended fund and you can stand up a new one, right? I've also had it like it was a remarkably simple. We had a very complex org chart with different feeders and masters and all this stuff that makes my life a lot easier because I don't have to worry about one fund just becoming a REIT. I can have everything feed into this thing, and that gives my client a lot more flexibility for their investors. So I find that the sub-REIT strategy is immensely flexible, both just in those operational aspects alone, but as they scale, now they have so many different options. To the degree where like now clients are now exploring securitization, they're exploring JVs, and they're integrating their REITs in one way or another with those strategies as well. And it's immensely useful because of the tax deduction, right? Beyond all of that, my thoughts have been like the only con that I can really think of is that the REIT itself needs to have the 100 or more investors. And this is one thing that I want everyone to, I don't want to get too deep on this, but like everyone asks this question. I've got 100 investors in my fund. I'm good, right? No, 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 no. The subsidiary REIT needs to meet the test, right? If you guys want to learn more about testing, we have a whole video on that. We can get through that with you guys through that video. I do want to touch on kind of the new developments now where we are in this kind of REIT world. I mentioned taxable REIT subsidiaries. First of all, kind of explain what those are. Who wants to, Dave, you want to explain? Because I don't think everyone really understands what they are, because there's a unique strategy to use them, particularly when it comes to things you shouldn't do in a REIT, like loan sales and foreclosure properties and selling REO. So give us the idea, give us the stage when it comes to what a TRS is, and then we'll kind of get into the new changes.
Yeah, so a taxable REIT subsidiary is simply a corporation that is owned, wholly or in part by a REIT. And what it's used for is to manage some of the REIT testing when you have assets or activities that are not good for REITs. So one of the, REITs if you're comparing a REIT to a traditional fund, REITs have a little bit more administrative stuff that you have to deal with. You have to make sure that the type of income and the type of assets that are generating income comply with the REIT standards. Most real estate backed loans will. But then you get into some nuances where, for example, let's just say you've made a loan to a hotel and you have to foreclose on that, or you've made a loan to a condominium development and have to foreclose on that. There's certain hotels and condominiums are two types or two examples of things that would create income that wouldn't be good for a REIT. Hotels, you can use a special purpose structure it's a lot of brain damage, but doable for a REIT. Condominiums, there's really no way around. So a lot of times taxable REIT subsidiaries are used for holding assets that would create the type of income that would be problems for a REIT. So I think it was back in 2018 or so, or maybe earlier than that, you're limited on the size, relatively speaking, of how big can a taxable REIT subsidiary be. So 20% was the standard for a long time. It went up to 25% temporarily, I think, as a way to help people get through the 2008, 2009 crisis, and then decreased back down to 20%. The big beautiful bill allows it to be up to 25% of the value of the REIT's assets. So it's helpful in the sense that you have a little bit more room if, say, you have one of your larger loans that converts to REO and that REO needs to be held in a REIT. This is a tool that allows you to do that without compromising your REIT status.
And for those listeners, where this becomes very useful is either loan sales, right? Loan sales is a big issue for REITs. That they're not the end of the world, but it complicates some of the compliance. And I've used TRSs significantly for clients who like to do loan sales. This added 5% is very useful. In the foreclosure world, I think that's the primary driver. It really makes the tax bill a lot easier on the client to do it this way, instead of moving the asset to the parent fund. Now, if you exceed 25%, you're going to have to use the parent fund. But what's interesting is this coincides with another kind of quasi recession that we're seeing in real estate, namely office, right? And so there's a significant amount of REO in office, and then also you're seeing it now in industrial real estate too. So I think it's very useful for our clients who are doing commercial bridge and commercial construction loans to think about. Now, the REIT is a very important topic, and I don't want to just like overshadow, the REIT strategy. For our listeners, one thing that was kind of a point of confusion. This goes to a question we got from Rob over at Boomerang. The deduction, there was some talk for a while that the deduction was actually higher, right? I think it was like 23%. I want to confirm, because I'm pretty sure that it's not law. It does not pass through. It did not actually end up being 23%. We're confirmed on that, right?
Stayed at 20%, correct?
Right. I think that what happened was the media kind of confused everybody. So it was in one of the proposed edits, and then it actually never made it through to the final bill. So it is.
Yeah, I think it might, Kevin, have been part of the Senate bill.
It was, yeah.
But I don't think when they reconciled and passed it in the final version, they did not increase it.
Yeah. And the Senate wanted to up it to 23 in the proposed amendments. So just confirming for our audience, it's still 20%, but that's really, really meaningful, in my opinion, because this is a ordinary income tax situation. It's always been the big downside of these funds, is that ordinary income is the harsh reality of these funds, but this is the only way to really get it down. I do want to touch into now some of the other aspects, because this bill has so many other aspects to it. Now, we're not going to get into deeper on SALT. We're not going to get into tax on tips and Social Security. We're not going to get into that, because honestly, you can listen to a bunch of stuff that's outside of our industry for that. We want to concentrate on what's germane to real estate and what's germane to lending. That bonus depreciation aspect, Ryan, you talked on it earlier. I really let's get a little clarity, because I've had many conversations around this with my real estate clients, but also lenders, and they don't really quite understand how it works. And my philosophy has always been the best lenders out there are constantly educating their borrowers. And so, there are a lot of new market entries into the real estate investor community. So help us understand this so we can educate our counterparties when it comes to this change.
Right. So when you buy property, you can kind of think of the property in three different categories. You have the land component, you've got the building component, and you've got the shorter lived asset component. Let's say tables, desks, items like that aren't structural. So what bonus depreciation does is it says, okay, of whatever you purchase, you can immediately expense 100% of whatever is non-structural or non-land and take as a deduction in the first year, which is huge, right? You get a deduction without spending money, and investor returns go up because you have more cash available to return.
So for our listeners, that means improvements to the property that are not structural. So if you're doing a rehab, if you're doing ground up construction, probably not all of it, but a good chunk of the improvements to the non-structural improvements are all now deductible. But it's a depreciation component, right? So the way it works is it can get recaptured, correct? I think we're having some audio issues up.
Correct. Yeah. Right. The depreciation deductions can be recaptured. So I guess one planning point for people to think about, whether it's for your deals or deals you may be involved with as a lender, the purchase price allocation really does have some impact, both, to the seller because of that depreciation recapture you mentioned. So the more value that you allocate to things like tables and chairs and washing machines, the more ordinary income the sellers like to have, or are likely to have. And then on the flip side, the more of the purchase price a buyer allocates to those kinds of things, the more they stand to deduct immediately. So purchase price allocations can be really important, especially if you're talking about larger transactions. I'd also note on the bonus depreciation that there are, again, one of the big themes of the big beautiful bill is to incentivize, production and investment into the U.S. There are even some kind of structural things that can be written off for certain industries now. And so I'd say a deep dive on that should probably be a session of its own. But the theme here is there are a lot of favorable depreciation rules that got extended and expanded. Going back to 2017 and the phase out that Ryan was referring to, adding bonus depreciation at 100% over 10 years was too expensive for the bill to pass under reconciliation in 2017. So it phased down. It's now back, and I think you'll see, if I'm handicapping it right, you may see a change in demand for certain types of properties. You may see that the tax benefits for some of the buyers are going to be very compelling. So it might create some artificial demand for things that people are going to use for like manufacturing and distribution and things like that. So you might see a big change in demand on commercial or industrial real estate. But I can't say that I've seen that yet, but it's
Right.
good to, Kevin, I think your point, and I totally agree with it, is that it's good to be aware of these changes because your borrowers and people you're transacting with, these are going to be very meaningful potential impacts to them if they're looking at how the bottom line on how do all of these things really affect me economically, pre-tax and after tax. So there's a lot of incentives that property owners, now have, or that have an expanded version of, that I think are going to change the demand for certain types of real estate. And I'm actually really excited about that. Excited, and very much excited that there are incentives to bring those types of things back into the U.S. And I think the bill does a good job of incentivizing that. But for this group, I would say just be aware that some of those incentives are out there. Depreciation is a really powerful tax deduction. The faster you can write things off, the better your deal will pencil out over the course of a lot of time. The time value element of these deductions is very compelling.
Right. And what on the depreciation, I was talking to a developer client of mine, and I was asking him, like, do you think that this is going to lead to a resurgence in STR, right? And he's like, you forget about the local rules that are now in place all over the country. And so that's what's actually stopping us. We're not really that interested in the tax deductions were always going to be a cherry on top. The cities are stopping us from doing it. So that, if you're thinking that this is going to make a big shot in the arm for the STR community, which is one of the groups that really benefits from this, it's tricky, right? Like cities like Palm Springs and Anaheim, like these big tourist cities, the STR community is struggling because of local municipalities and their regulations. One thing that's not on the slide deck that I like to bring up also is that the One Big Beautiful Bill Act also give us clarity as to the future of qualified opportunity zones. Now, I know we don't spend a lot of time on this. Jason, you and I used to do them back in the day, but just want to touch on this real quick. It's basically made the program permanent. There's going to be renewals every 5 years, it sounds like, which is really great for hopefully building more infill into rural communities and low-income communities for building affordable housing, and also adding more industrial real estate. I think those are the two industries that really, really benefited a lot from QOZ, and of course, small business as well. So for those of you who are doing commercial real estate, those of you who have experience in the QOZ industry, I would take a look at that as well because it's a really nice alternative to 1031 tax deferrals, and sometimes it's just the only saving grace for those kind of investors. I
Yeah,
do
and
want to,
Kevin,
yeah, go ahead, go ahead.
there's kind of two ways to think about those, and on the one hand, for those of you that have high amounts of capital gain, if the QOZ stuff is can be really compelling in the tax outcome. where you don't have to pay tax on a good chunk of the gain that you have today, and you never have to pay tax on the gain when you exit whatever you're going into in an opportunity zone. So as an investor, it can be fairly compelling. We've also seen like the emergence of QOZ funds. So some of our clients who have sponsored other types of vehicles have also started QOZ platforms. So I'd say there's opportunity there both as an investor, and for whatever it's worth, I would kind of tell people don't do this just because you get the tax spiff. Make sure you believe in the deal that you're investing into. But also, as a fund sponsor, if you set these things up and you get into some compelling assets, there's a lot of incentive for people to invest in those kinds of things.
One,
Yeah.
one other thing, that there's been like a pile-on effect to the qualified opportunity zones, not actually being in a QOZ fund, but not actually like investing in it, but the assets and the properties adjacent to a qualified opportunity zone. So if they're doing a development across the street, the properties around and surrounding that opportunity zone that's actually being redeveloped have all seen a bump in valuations.
Yeah.
So it's been a good pile-on effect of, maybe that particular asset is in a qualified opportunity zone, but the surrounding across the street is, and that value immediately takes a step
That's how
forward.
that happened in Los Angeles, right? Because there was a pocket of West LA, Mid Wilshire, downtown that was considered to be a QOZ, but the surrounding area all of a sudden saw a huge bump in valuation. So
Yep.
and we'll see the same thing. I mean, I think people are excited to see that, especially in Texas, because they've been having valuation challenges, and same with Florida. And the nice part is now they have a set methodology in designating the zones, so we don't have to worry about people rushing to the finish line to and make a big mistake like they did in Imperial County. And so I think this is a very, very useful thing for our people who are thinking about real estate investing. But from a lender standpoint, I think you'll see a resurgence of interest in the commercial real estate side, because that was a big, big driver for QOZ real estate investors. And I think it'll continue, it'll resurge, particularly in areas that are kind of low income or rural. That seems to be the concentration of the bill.
Yep.
And also because rates are so high and so volatile, this is a very interesting alternative to DST strategies, which were all the rage when rates were low. And so I think this is a very good part of the bill. I'm excited that it's back. I'm excited that we don't have to worry about it going away. And our listeners right now, we will probably see a resurgence of that industry come back, and there's going to be events and promotions and all that kind of stuff for that as well. So I encourage everyone to look into that as well for their real estate investing.
Yeah, and Kevin,
Go ahead.
sorry, if I could really quickly, I just want to highlight something Jason said. With those, initially, I would say some of the properties that were within the QOZ got a little bit of an artificial bump because there was a demand for those, so people could qualify for the incentives. We also had a lot of conversations about, buying the property across the street, knowing it wasn't in the zone. But if the QOZ program works as it was intended to, meaning it creates development, it enhances the values there, it should also enhance the value of property across the street if these things work. So initially, like, people were happy when they owned property within the zones because they got the bump. And then as time's gone on, we've seen a lot of our clients kind of kicking around the idea of, should we buy some stuff across the street, knowing it's not in a zone today.
Yeah. And to be clear on the ozone program, it applies both to real estate and to businesses. So if many of our clients are interested in, interesting startup strategies that work, they actually do work. So there's a lot of ways to look at that. This is not an ozone webinar, but like, if you're interested in all that, let's have a conversation. Now let's talk about the last component that we wanted to touch on as the ancillary kind of pieces of the bill. We were worried about this, right? There was a lot of conversation of getting rid of the carried interest, quote unquote, loophole, right? And there was a lot of discussion about raising the tax brackets, basically the tax rate, right, on the individual side. We comment on that really quick because I think it's important. And we don't have a lot of carried interest concerns in our space. It's all ordinary income, interest income. But for our real estate investors and also our clients who have holdings in real estate, this is a very meaningful thing.
Yeah, on the real estate holding, the concern was carried interest typically outside of a real estate asset. If if you want the long-term capital gain treatment, you've got to hold the asset for longer than 3 years. There's a special carve out for if the property is real estate, you can qualify for the carried interest if only being held a year. The concern was they were going to get rid of that year holding and move it to 3 years, similar to non-real estate assets. Good news is that went away. It's still just a 1 year hold where you get the long-term capital gain treatment. Um, super favorable there, as well as the top rate for individual taxpayers and every level really is reduced. So that was set to go back to the top rate of 39.6%. However, the bill extends the top rate to 37% permanently.
All right. I think that's all the topics we have on the slide deck. If our listeners have any questions about this bill, their tax strategy for their business, REITs, how can they reach you guys?
Best way would probably be through our website initially, or we're happy to share our direct contact information with anybody who's interested. Kevin, if they have a way to ping you, we're happy to do that, or we can put it up on screen now if anybody's interested.
All right. And as you guys know, you can find us at fortralaw.com. You can email me at k.kim@fortralaw.com. Also wanted to do one little bit of housekeeping at the end. Any questions from our audience? We've got a little bit of time left. Want to make sure we answer any questions. I know you guys have some burning questions about tax, but if you don't, but if you want to ask, please use the Q&A button and ask away, and we can get to them right away right now. Nobody? I guess Rob is the only one that's really deeply passionate about tax. All right, guys.
Well, Kevin,
go ahead.
Just one point. You know, a lot of the questions will probably come up as you start to think about how do I do this or should I do this? You know, we have walked a number of clients, and I'd say dozens and dozens of clients through the process of, you know, should we do this? And once the conclusion is we want to do it, then how do we do it? So, you know, REITs can be a little bit scary for those that are not familiar with them. There's a lot of stuff that you know you need to take care of with it. So I'd just say for those that just want some education on that and what it looks like, we're happy to have those conversations. For those that decide to do it, and you know you're like, oh boy, I've got to now figure out how to do all this stuff. You know, Kevin and his team, as well as our team, are very familiar with the process of implementing these types of structures. Can help you with, you know, we've helped with a lot of investor questions when those come up as to why, you know, why does it make sense? Why do you guys want to do this? So we would, I guess just the message is if anybody's out there, you know, thinking you want to consider it, we're happy to have conversations with anybody to talk about what it might look like and how to do it if you decide to.
Yeah, I like it. I mean, if you're running a debt fund right now in private lending, I would say contact one of us for a consult, because this is something that you really want to think about. It's a huge boon to your investors. It doesn't matter how big you are. It's worth learning about in detail. And we'll also make sure we share the other webinars we've done on this topic so you guys can learn more. Last point of note, I want to make sure
Kevin, I saw a question from
oh, great. Yeah.
Jack.
Let's see a question here.
I think it
we
had
did
to
get a
do
question.
with where the management fee would be charged, like meaning to the REIT or to the fund. I think the management fees are initially charged to the fund just based on the way the documents work. But what we've done is we've worked with a number of clients to say that, you know, the assets all reside in the REIT. The asset management fee largely should be borne by the REIT. So, Jack, I'm trying to answer the question thoroughly, but I'd say the asset management fee is still charged by the fund, or charged to the fund, I should say. But the expense, I think we push for people to record all of it or the majority of that asset management fee to the REIT, which is where the assets reside.
And this really, from a legal standpoint, just requires an additional line item in the documents, disclosing optionality. And there's another question here from Gwendolyn. Can we accept EB5 investors in a REIT? Okay, so I think I'm the only one that can actually comment on this because I've done a lot of EB5 work. EB5 does not really work in these contexts because these loans, like EB5 requires an investment that will create jobs. And so when it comes to a mortgage fund, a debt fund, we are lenders, right? So a lending fund is not designed to create jobs. They don't create jobs, right? They make loans. There's no economist out there. I've heard people try to do this. There's no economist out there that's going to do this allow this for a lending fund from an economic study standpoint. Now, there are EB5 strategies that are loan based, right? They make mezzanine loans or first position loans to a construction project that will create jobs. If you have a multi-strat strategy, meaning that you have multiple loans in your EB5 strategy, in your NCE, right? Then you might be able to consider this. However, because the rate of return is so low in an EB5 NCE offering, you use a fund structure, say you're doing like 5 loans, something like that, or 10 loans even. Because the rate of return is so low, a REIT strategy actually may not be that meaningful because the investors are not looking for a deduction. In fact, they're typically not even US people, right? So that's kind of a problem on that front, right? So it's it requires a little bit of nuanced thinking. I have seen it used for EB5 companies that will take their EB5 investor after they finished, right, and they need to do a redeployment. They will stand up some type of debt fund, investment fund that is real estate focused, and that will be a REIT structure because that gives tax benefits. And by that point in time, the investors will be considered US tax people, so they can get that benefit. But it's a very complicated planning exercise. So Gwendolyn, if you are in the EB5 industry, please contact me. I'm happy to walk you through all this. We've done a lot of EB5 projects for NCEs and regional centers. All right, last point of note. I want to make sure we let everyone know about our upcoming conference here at Fortra Law. We are hosting Innovate again. This is our 8th year in a conference. We will be doing it on August 21st through the 22nd at the Vea Hotel here in beautiful Newport Beach. And you can see the information here on the slide. The website is fortracon.com. There's the cost to attend. This year, we're adding some additional layers of education via I'll call them roundtables, day before the conference. So the way it's going to work is the 21st is going to be roundtables and then welcome reception, which is also really fun because we're going to be right in front of the Vea Hotel courtyard. We're going to be overlooking the ocean. Beautiful, beautiful event. The conference will begin on the 22nd. The main day of the conference will be on the 22nd. So if you're interested in learning more about this conference, please contact us, or you can learn more at fortracon.com. I think that's all the time we have today. We have about 2 minutes left, so that is all. For those of you who are listening, thank you for listening to this webinar. And if you want to find it later, it will be on our YouTube page. Just search Fortra Law on YouTube, and it will be there pretty soon. Thank you for listening. This is Kevin Kim, signing off.